On March 1, 2008, AOL's stock ticker surged as the tech giant announced it had paid a staggering $850 million to acquire Bebo, the once thriving social network that was still counting its users in the low millions. Less than 5 years later, that same platform would be sold for a single-digit, $1 million, leaving industry insiders to wonder how a deal of such magnitude could evaporate so completely. Bebo's story began in 2005, when Michael and Zachai Birch, two entrepreneurs fresh from a modest startup background, launched a social networking site that promised something no other platform could deliver at the time: a seamless blend of photo sharing, music integration, and a real-time friend stream that mimicked the energy of real-life gatherings. Early adopters were drawn to its clean design and the ease with which they could embed videos from YouTube, stream music from popular services, and customize their pages with a level of personalization that Facebook, still in its college campus phase, had not yet mastered. Within a year, Bebo's user base swelled from a handful of thousand to over 10 million active members worldwide. By the end of 2007, the site boasted more than 45 million users, a figure that attracted the attention of advertisers hungry for the emerging digital audience. Bebo's revenue model hinged on a combination of banner ads, sponsored content, and a premium, Bebo Pro, subscription that offered advanced privacy controls and enhanced media storage. The company's rapid growth earned it a valuation of $300 million, and investors began to whisper that it could become the next Facebook. The warning signs, however, were already embedded in Bebo's architecture. First, the platform's rapid scaling outpaced its engineering team's ability to maintain performance. Users frequently reported lag during peak hours, and the site's servers struggled under the weight of high-resolution photo uploads. Second, Bebo's reliance on third-party services for video and music streaming introduced licensing complexities that would later prove costly. Finally, its revenue model, while diverse, depended heavily on advertising rates that were volatile and subject to the whims of a market still learning how to price digital impressions. AOL's acquisition in 2008 was hailed as a bold move to re-enter the social arena after the failed purchase of Netscape a decade earlier. The $850 million price tag was justified by AOL's board as a strategic investment. Bebo gives us a foothold in the younger demographic that has eluded us for years, declared a company spokesperson at the time. For the Birches, the sale represented a validation of their vision and an influx of capital that could fund the next wave of innovation. Yet the honeymoon period was brief. Within months, AOL's leadership began to impose aggressive integration strategies that clashed with Bebo's startup culture. The corporate bureaucracy introduced layers of approval for product changes, slowing the rollout of new features. Meanwhile, Facebook was expanding beyond college campuses, launching the news feed in 2006 and opening its platform to the public in 2007. Its relentless acquisition of talent and rapid introduction of mobile applications began to eclipse Bebo's offerings, especially as smartphones grew from novelty to necessity. By 2009, Bebo's monthly active users had plateaued at roughly 40 million, while Facebook surged past 150 million. Advertisers followed the traffic, diverting their budgets toward the platform that promised richer data and more precise targeting. Bebo's ad revenue dropped by 30% in a single quarter, and the company was forced to lay off a third of its workforce. Internally, morale sagged. Engineers whispered that the platform's codebase had become a spaghetti nightmare, a product of rushed patches and half-finished features. In 2010, AOL attempted to revitalize Bebo with a series of redesigns, introducing a new interface that emphasized mobile compatibility and a Bebo for Brands suite that allowed companies to create custom mini-sites within the network. The effort was costly and, more importantly, mistimed. The mobile market was already dominated by Facebook's dedicated apps and Twitter's real-time feed. Users who did migrate to mobile found Bebo's apps clunky and slow, leading to a rapid exodus to competitors offering smoother experiences. The final blow came in early 2012, when a data breach exposed the personal information of millions of Bebo users. Although the breach was smaller in scale compared to later incidents at larger platforms, the damage to Bebo's reputation was irreversible. Trust, once lost, is difficult to rebuild, and advertisers pulled out in droves. AOL's quarterly reports began to list Bebo as a non-core asset, and the board initiated a search for potential buyers. By June 2013, the negotiations concluded with a little-known private equity firm acquiring Bebo for a symbolic $1 million, an amount that barely covered the cost of transitioning the servers to a new hosting provider. The sale price starkly contrasted with the $850 million purchase price just 5 years earlier, illustrating a classic case of overvaluation, mismanagement, and an inability to adapt to a rapidly shifting digital landscape. The aftermath of Bebo's collapse rippled through the tech industry. Investors grew more cautious about high-valuation acquisitions of social platforms, leading to a wave of due diligence reforms that emphasized sustainable user growth over headline numbers. The Birches, though publicly humbled, returned to the entrepreneurial sphere, launching a series of smaller ventures focused on niche community building. AOL, reeling from the loss, eventually spun off its media assets and refocused on content creation, a move that helped the company stabilize but never recaptured the social dream it had once pursued. Subscribe to The Collapse for more stories like this.